All right. Well, again, welcome. Thank you for joining us for our first time homeowners workshop. These are what we're going to talk about today on your path to home ownership. So let me introduce myself. My name is Joe Canfield. I'm the Assistant Vice President Mortgage Loan Officer here with Community State Bank, and I service the locations of Racine, Union Grove, and Kenosha. My contact information is on the screen and will be at the end of the presentation if there are any follow-up questions or if you would like to set up an appointment. Today, these are the topics we're going to be covering. We're going to talk a little bit about renting versus owning, establishing a budget, your credit, resources. We're going to talk about the buying process, realtors, and closing day, what that all entails. So rent versus own, some things to think about. When deciding whether to rent or buy, it helps to think about what matters to you, your lifestyle, and your finances, along with your future plans. Both options have their perks and challenges. Renting can offer flexibility, while owning can help you build stability and equity over time. So when you rent, you do have that flexibility to move whenever you want once your lease ends. That could be flexible because you could choose your school district you want to be in and not be just tied down and having to worry about selling a house. You also have the same monthly payment for the duration of your lease. So most landlords will have you sign a year or 2-year lease, and that will keep that monthly payment the same until the end of the lease. If something breaks down or is in need of repair, you are not responsible for that while renting. As the landlord, it is their property and their responsibility. But keep in mind, when you are renting, the landlord may raise your rent after the lease term, or they could decide to sell the property and you may have a new landlord or have to look for a place to rent or live in after that. Another thing with renting is you're not able to personalize the property to make it the way you want. So let's say you wanted to change a wall color or change fixtures or flooring. You could be limited in your options based on your landlord. Now, when you own a home, these are some things to think about. It does provide you a sense of stability and community. You're a part of that community and you're putting roots down there. You can personalize that house. So you want to change the flooring or wall colors or maybe add a deck. Those are all things that you could do because it is your property. But you want to make sure to check with your local ordinances and follow all permits and procedures. You are responsible for all repairs and maintenance and additional costs like utilities and insurance when you own the home. So you want to make sure that you plan for those things and have a good savings and work on your budget and a lot of things we're going to talk about today. Now, also, when you own a home, you are building equity. And you may ask, what is equity? Well, home equity is the amount of the home that you own. It's your home's value minus what you still on your mortgage. As you pay down your mortgage and the value goes up, you're going to have more equity in that property. And you may borrow from that later down the road to maybe do upgrades or repairs. Now, when thinking about home ownership, one of the first steps is budget. To determine what you can afford, review your income, your monthly debts, and the amount of savings you have. A good rule is to keep your housing expense under 28% of your gross monthly income, and all debts with that under 36. This is going to make sure that you are in a good position to be very comfortable making your mortgage payment and paying your other debts while also being able to save. You want to make sure your down payment when you purchase a home doesn't drain your whole savings and that your budget reflects what you can truly manage, not just what you may qualify on paper. Because at the end of the day, you're the one that's making the payment and you do have to be comfortable with that. So the first step, establish a budget. You want to take a look at and see how much of your income is going towards current expenses, towards savings, and how much you'd be comfortable to have go towards your monthly mortgage payment. It's also a good idea to set a savings goal. That could be a goal towards your down payment, towards repairs, rainy day fund, but the goal is to save and save as much as you can. It also is a good way to look at your expenses. Are there things that you could pay off in a short time that you no longer would have to pay anymore once paid off? Or are you able to reduce more debt so that more money could maybe go towards your mortgage payment? You could also look at ways to increase your income. I've worked with some customers that have gotten like a small part-time job on the weekends to help increase income, or find out that one of their hobbies is something that people would like to purchase as kind of their own small business, or be a good time to look at that promotion at work. Another thing with your budget and with saving is maybe open a separate account and automate your savings. So a lot of employers will allow you to split your deposit where you could have a portion sent to one account and the rest into your operating checking account. Or through your bank or credit union, you may be able to actually send money on a monthly basis and automatically do it. That's huge. It's really good to have that, and it also limiting the access to that. So don't dip into it unless you have to. And again, you're going to want to consider that rule of 28 or 36, that we want to keep that housing payment no more than 28% of your income and all debts at 36. So what are some of the costs? So when you buy a home, you do have to plan for more than just the price of the home. You need funds for your down payment, your closing costs, and prepaid expenses. Those are things like your property taxes and homeowners insurance. After moving in, you're going to have to budget for repairs, for maintenance, and for the monthly utilities. Setting aside extra for unexpected costs will help you stay comfortable and confident in your new home. So, what is your down payment? Well, that is required by the lender for the mortgage loan. Down payments can vary, and we have programs that actually allow you to get in a home with as little as 3 to 5% of the purchase price down. What are closing costs? Well, those are the costs incurred to get the loan. The lender will need to do an appraisal, title work, flood zone determination, and there are some other verifications that need to be done. And those are all the costs associated with getting a mortgage loan. Prepaid expenses. That would be like your homeowner's insurance. So when you purchase a home for the first time, you do have to prepay your first year of homeowner's insurance. So that's something you want to make sure is in your budget. You also have to put aside money for the property taxes. That can be done automatically with your mortgage if you'd like, but at closing, you're going to need at least a month or so to contribute to get that started. And then maintenance and utilities. So maintenance on a home, there are certain things throughout the year you're going to have to do to keep it looking great and maintained. So you want to budget for that. And one way with utilities would be is to work with your local utility provider and see if they offer a budget billing where you could actually pay the same all year round to help keep that cost the same instead of it going up or down depending on the season. So let's kind of give you a monthly payment example. So for this sample illustration, we're going off of a $200,000 purchase price with a 5% down payment. So you would need $10,000 and a loan for $190,000. So your principal and interest payment based on a 30-year mortgage at 6.25% would be $1,170 per month. Let's estimate the property taxes are $300 per month. Homeowners insurance. Now, you did hear me say you have to prepay the first year, but you're going to have to save every single month for that to pay it again in full at the end. So let's say that's $100. That is something that you can shop around for. So you can find the best rate and something that works well in your budget with great coverages. Private mortgage insurance. For this estimate, we're putting in $100. And what is private mortgage insurance? So when you purchase a home and you put less than 20% down, the lender requires private mortgage insurance to be added to the loan, and it needs to stay on there until you build up that 20% equity. It's not something that's on there forever, but the more you can pay down on your monthly payment and the higher your value, the quicker it could go away. Private mortgage insurance is something that's only necessary, like I said, if putting less than 20% down. And overall, in this example, your monthly payment would be $1,670. The actual cost for those things could depend on credit score and the actual amount you put down. So now let's talk a little bit about credit and your credit score. Why is it important? Well, a credit score is a number that shows how reliably you manage debts and payments in the past. When buying a home, lenders use your credit score to decide if you qualify for a loan and what interest rate you will receive. It can also affect your closing costs. Higher scores often mean better rates and lower monthly payments, while lower scores can lead to higher costs or make it harder to get approved. As you can see on the right, 67% of Americans have a good FICO score, which that would be considered a 670 or higher. So that's a great place to aim for. And looking all around, it definitely is very important for you to keep an eye on that and have your score as high as possible. Now, what's the minimum to get a mortgage loan? It does vary depending on the product and the lender. Most products do require a score to be at least a 620 or higher, but we're going to aim for higher for that. So with your credit, what are some do's and don'ts of credit? Well, you do want to check your credit report. You want to be able to see it and make sure everything's up to date. You can do this for free by visiting annualcreditreport.com. You will get your free score and report from all three major credit bureaus. That's Experian, TransUnion, and Equifax. It is for free and it does not impact your score. What does that allow you to do? Well, you could correct any errors. Let's say there's a medical collection on there that you didn't know about that's already been taken care of. It gives you the opportunity to get that taken care of so that your score is at its highest potential. You also want to make sure you're paying your bills on time. So when looking at your overall credit score, the biggest factor to determine if your score is going up or down is your monthly payments and how you pay them. Even being late one time could actually hurt your credit score for well over a year. So pay everything on time. When you review your credit, you also want to make sure you're reducing outstanding debt. So if there are things that you can eliminate, try to do so, because then that's more money that you could put towards savings or towards your mortgage payment. You also want to avoid opening new credit. My general rule of thumb is only apply for credit when it is absolutely needed. That's going to keep inquiries down, and it's also going to show a credit stable history. You also want to make sure you're diversifying your credit. So you don't want just this one type of credit. You don't want to have just all revolving, which would be credit cards, or all installment loans, which would be like how a mortgage loan or second mortgage or personal loan or car loan is. And you also want to keep old accounts open. You don't want to close an account that has been open for a long time, because credit really depends on how long you've had credit, what types of credit you have, and how you pay your credit. So what are some don'ts of credit? Well, kind of to go with the first do, you want to make sure you're not going long periods of time without reviewing your score. This is to make sure that everything is up to date, accurate, and that you are not a victim of fraud or identity theft. You also don't want to pay bills late. We kind of touched on that, but again, I like to really stress that important. You also don't want to keep balances on revolving lines near their limits. The general rule for credit cards is you don't want to spend more than 30% of the limit. If you can actually do less than that, your score is going to stay a lot higher. It's very important because credit really looks at it and says, okay, here's the limits that you have. How do you manage them? By keeping the balances low, that is showing you're managing that and not depending on that. You also do not want to open new credit cards for promotional discounts. I know that can be very tempting when you go to the store and they offer you 20, 30, 40% off, but doing that could do more harm than good. When you do that, you're having an inquiry done on your credit report, which stays on there for 2 years. You have a new credit line that opens, and that's going to bring down your score because it's something new and they don't know how you're going to pay it. And until that has payment history, you're not going to get those points back. So again, only apply for credit when you absolutely need to. You also, like I said, don't want to have just one type. So if all you have is credit cards, you may want to look at doing some sort of installment loan to be able to have a good credit balance. A general rule of thumb is if you have 2 credit cards, you actually should have one installment loan to offset that, to show a variety of credit. And again, never close old accounts. So when you review your score report, it shows you when the account has been open and how long you've had it. You'd want to make sure that you're keeping those open. Also, too, when talking about credit, is opting out of pre-screen offers. I don't know about you, but at home, I get junk mail all the time that says you're pre-qualified, pre-approved for this credit card or this personal loan. That's a pre-screen offer. I even get telephone calls for it too. A pre-screen credit offer is when a lender checks basic credit information to see if you meet their criteria and then invites you to apply. Now, when you apply for a mortgage, there are other mortgage companies out there. They pay the credit bureaus to sell that inquiry data to them so they could solicit and offer you different products and services. It can get kind of annoying to have your phone ringing off the hook from sometimes 5, 6, 7 different places that you don't have a relationship with that's trying to say, no, come join us. That's why it's very good to work with your own community banker, because we work directly with you before, during, and after the process. So how can you stop these things from happening? Well, you can visit optoutprescreen.com and opt out online. Choose the electronic option, and it's good for 5 years. Then put it in your calendar in your phone for 5 years to remind you to do it again. I always just, once I start getting the notices again, that's when I know I have to go back online. It does take 5 days to be active, so you would want to make sure you do this well ahead of applying for a mortgage. So we've looked at your budget, you've reviewed your credit. Now you really want to get serious about maybe looking into a home and getting pre-qualified. Well, what does that mean? A pre-qualification means a lender has taken a quick look at your basic financial information, like your income, your debts, and credit, to establish how much you may qualify for. It's a simple first step that helps you understand what price range you can be in without affecting your credit score. So how do we do that? Well, we use a soft credit check. No impact to your score. You're not applying for anything at that time. That's vital because we want to safeguard and not have too many inquiries. The lender is going to review your income and debts to kind of see where you are. Also, if anything pops up that doesn't look right, it gives you time to maybe fix or reduce debt before actually applying. If everything looks good and it's in a comfort range that you're comfortable with, we can issue a pre-qualification letter that says, I'm ready to move forward in the loan process and start looking for a house. So I know I've covered a lot so far, so I'd usually like to pause right here to be able to answer any questions you may have. I'm going to go ahead and we'll check the chat area to see if there's anything I can answer directly for you. Now I'll just give it a couple more seconds here. And again, throughout the presentation, I do have other community state bank representatives that are helping answer questions while we're presenting too. All right, perfect. Then we're going to move on. So now we're going to spend a few moments talking about the products and services available here at Community State Bank for your mortgage lending needs. On the left-hand side, our traditional products. We have our fixed rate loans and our ARMs, which ARMs stands for adjustable rate mortgage. On the right-hand side, we have our WIDA home loan option and our Home Ready. So let's start with the traditional products. So a fixed rate mortgage has a minimum down payment of 3 to 5%. The advantage of having a fixed rate mortgage is just like it is in the name. It gives you the security of always knowing what your monthly principal and interest payment is going to be for the life of your loan until you pay it off or refinance it. A fixed rate mortgage is a popular type of financing because it gives you that predictability and stability for your budget. An ARM, or again, short for adjustable rate mortgage. Minimum down payment on that is a little bit more at 10%. An adjustable rate mortgage offers you a starting rate that is lower traditionally than the 30-year fixed, but the biggest difference is it is only locked in for a 5-year period of time. So after that 5 years, your interest rate can go up or down each year depending on where the current market rate is. This program is really good for people that maybe they're not planning on staying in the home for 5 years and going to sell it and maybe upgrade to a different one or move to a different area. It also is a good option to take advantage of a lower rate right now, and it gives you a locked in period of time of 5 years that you could watch rates to potentially do what's called a refinance to then get a lower rate down the road. Again, you would have to pay separate closing costs and things when you do a refinance. Now, both of these loan options, if your down payment is less than 20% of the purchase price, it is going to have that private mortgage insurance that we talked about before. And again, that needs to stay on there until you have that 20% equity or more. Now, what are some of the flexible options, especially for first-time home buyers? So we do offer a WIDA loan, which WIDA stands for the Wisconsin Housing and Economic Development Authority. Sorry, that's a little bit of a tongue twister. They have mortgage programs that are good for first-time home buyers, repeat buyers, or even refinancing a mortgage. Low down payment of 3% and that private mortgage insurance that you would have to pay is actually at a reduced premium through WIDA. Those are some of the advantages with WIDA. Now, to be eligible for a WIDA program, there are income limits depending on the area of the home, and you would just need to speak with your local lender about that when applying to see if this is a good product for you. The other loan program is called Home Ready Loan, and that is a Fannie Mae product. Home Ready Loan is a special type of mortgage that helps people with low to moderate income refinance or purchase a home with little to no money down, again, with only a 3% down payment. The Home Ready loan is unique that it also has the reduced private mortgage insurance premiums, and it also has creative ways that could help towards your down payment or actually getting qualified for the mortgage. So traditional mortgage products, like let's say you were going to have a roommate that is going to be renting a room out in the house. Well, other traditional mortgage programs, they say you have to have received that for at least a year before it can be counted. Home Ready doesn't have the same things, and they're a little bit easier with verification with down payment and everything. So it is a great product for a first-time home buyer if you qualify. They do require you to take an online course for homeownership, which also is free, and it gives you a lot of great information as purchasing a home has a lot involved. So now when thinking about down payment, one of the questions I always get asked is, well, are there grants or is there help that could be done to help reduce that cost? Well, through Community State Bank, we work with the Down Payment Plus grant, DPP for short. What is that? Well, it's a grant that helps home buyers cover part of their down payment and closing costs when purchasing a home. It's offered through us and funded by the Federal Home Loan Bank of Chicago. You could get up to $10,000. Now, you must meet income and household size requirements for the grant, and you do have to complete a pre-purchase education course and counseling session. All of that can be done online, online through Fannie Mae HomeView. You can do their free course for the education, and then you would just need to work with a local HUD approved counselor. I could help get you a list for that. If there's any cost for the counseling, the grant can go towards paying that as well. So there is no money out of pocket. And there are also online courses that can be done and counseling. Now, you must contribute at least $1,000 of your own money towards a down payment. And as long as you own the home for 5 years, you do not have to pay it back. Now, people will ask me and say, Joe, what happens if I sell the house and it's year 4? The grant, do I have to pay back the full 10,000? At that point, no. It would be prorated depending on how long you were in the house, and you would have a lower portion. So this is something that you would talk to your lender about to see if we could get you qualified for this and the steps needed to secure the grant. Now, you've talked about your budget, looked at your credit, got you a pre-qualification letter. Now you're ready to start looking for a house. So what do? It's good to work with a local realtor. What are some of the benefits of working with a realtor? Well, they are the experts and they have the local knowledge for your home search. They offer honest insights about properties and the neighborhoods that those properties are in. They also help you find a home that fits your needs. They can send you listings, set up showings. They're the experts and do everything they can to help you get you into your first home. They also ensure fair, ethical service throughout the process. And they help with the negotiation and filling out the long paperwork contract for that offer to purchase. They make it look easy. Now, you would think after you get an accepted offer, their job is done. No, they coordinate with the lender, the title company, and the seller's agent, all to make sure everything is on track for a smooth transaction. And even after you own the home, they become a really good resource for you to provide you updates with potential increases in market value of your home. Or if you're ready to embark and sell that home and purchase your next home, they're really good to work with. Have that accepted offer on the home, there are going to be some documents that are required by the lender. These are the list of items that are needed. Typically, we're going to need your most recent pay stub. We're also going to need your last 2 years W-2 forms. And if you have rental income or are self-employed or have any business income, we would need the last 2 years of your federal tax returns, personal and business. 2 months bank statements from all accounts, and your most recent investment account statement. These are needed to verify your current income, assets, and amount, and to be able to get everything together for down payment and qualify those. Now, after you've got your lender, everything like that, you got your accepted offer, got all the documents to the lender, a good idea is to have a home inspection done on the home. A home inspection is important because it reveals hidden problems like roof damage, plumbing leaks, electrical issues, and they make sure that your property is up to code and it's in good functioning order. It can also make sure that you're informed so that you can make the decision on if this is a good home to buy and can avoid costly surprises before buying. They are going to look for those potential safety risks. They also may help you gain leverage as a buyer. So if the inspector finds items wrong with the home that need to be addressed, you may be able to renegotiate if you have it in your contract to either have those fixed before closing or potentially have the actual price of the home reduced to offset that. But the biggest thing it does is it helps you plan for future costs. They let you know kind of the age and condition of the major mechanicals like the heat, the air conditioning, the roof, the siding. These are going to be your big ticket items that if need to be replaced, it's going to be something you're going to have to budget and account for. But the biggest thing gives you that peace of mind about buying a great home. I know when I got my home inspection, my home inspector, They told me the age of like my water heater and showed me how long until I'd have to replace it, how old the roof was. And then they kind of gave me a roadmap to say, these are the things that you should do now, things that you may have to do in 5 to 10 years or 10 plus. So it really gives a lot of good information. Now, also through the loan program, or excuse me, through the loan process, an appraisal will need to be ordered on the property and also title work. Well, what's an appraisal? An appraisal is an independent estimate of a home's market value completed by a licensed appraiser. It confirms the price you're paying for the house is what it's worth. So it gives you that peace of mind. And some of the things that they look for on that is the condition of the home, the location, and recent sales of similar properties. The lender requires this, especially because they're lending you the money to purchase a house. Now, what does a title company do? Well, they make sure the property you're buying has a clear title, meaning no legal issues, unpaid taxes, or ownership disputes. They handle the title search, issue the title insurance policy, and coordinate the closing, ensuring all documents are signed and funds are properly transferred. Basically, they are the glue that makes sure that everything transfers from the old owner to you without a hitch, without any problems or liens, judgments, anything like that. It's your house. So now you've gone through all of this and it's closing day. So who attends the closing? Well, you'll be there as the buyer. The seller will be there in most cases. Your real estate agent, along with the seller's real estate agent, the lender, and the title company officer. What do you need to bring? Well, you need to bring your ID because we need to make sure that you are who you say you are. You also would need to bring any funds needed for closing. That could be in the form of a cashier's check or could be a wire. You also want to bring your lucky pen, but don't worry. If you forgot it, one will be provided for you. And the last thing, you would want to bring questions that you have for the seller. It's a good idea to think about this ahead of time and maybe write them down because you may never see them again. Some things you may want to know is like, what day is garbage and recycle day? Or do you have any specific questions for them about things that may be in the home or about any warranties on any of the appliance or any paperwork? It's like I said, it's a very good opportunity to be able to talk to them and get all your questions answered. And then after the closing and you sign, you get to enjoy your new home. You get to make it your own, move in and enjoy it for years to come. So I personally want to thank you for joining us today. I really hope the information that was presented was very resourceful, educational, and I do have my contact information on here. Again, if you have any questions, don't hesitate to reach out. I can be reached by phone, email, even if you just want to set up an appointment to be able to kind of take a look and see where you are. I'm always about the more knowledge and information you have, the better off you're going to be. And I'm going to try to give you as much as I can. And the biggest thing is I'm here for you to try to do whatever I can in any way. So thank you again for joining, and we will leave the chat open for a few more minutes in case there are any lasting questions. But otherwise, I hope you enjoy the rest of your day.